Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. One of the questions I do get in my practice occasionally is to discuss insurance, and I found a great article by a woman named Emmy Hall. It was published on the internet September 1st, 2018 at 5 a.m., and it's called 10 Car Insurance Terms You Need to Know. And I really think this is a good thing to spend a few minutes talking about today. It's understanding the legal terms is the key to getting the coverage you need. And let's face it, folks, a lot of us don't understand some of the things that go along with getting car insurance. Now, I've kind of become an expert in this area now that my second child is now driving and we've got him on our insurance. So I thought I'd take a little bit of time and talk about the different coverages and some terms that are important. So let's start with the basics. There are really two types of coverage. There's a collision coverage and comprehensive coverage. And let's take a minute to talk about that. Collision coverage is the kind of coverage that pays for damage to your vehicle no matter who is at fault. This is the type of thing if you drive a new car, a classic, or just something near and dear to your heart. Collision coverage is a great buy. In fact, if you're financing, then you are probably going to be required to have this, and they may even talk about the minimum deductible that you can use. As a counterpoint to that, if you have a really old car that doesn't have much value, this is a coverage you may decide to decline. Now, that's the collision coverage. Comprehensive coverage, this pays for damage to your car or truck not caused by a collision with another vehicle. And it mentions in this example, ex-lover took a baseball bat to the quarter panel. Covered. Hit a deer. Covered. Car stolen from the mall parking lot. Caught fire during a riot, floated away during a hurricane, covered. And as with collision coverage, comprehensive is worth the price if you drive a new or otherwise valuable car. And it too could be mandatory if you're still financing your ride. Now, all of this brings about, well, what happens if there is an accident or a claim? Well, then you're going to start talking about the word deductible. A deductible is the amount you pay out of pocket for repairs when making a claim before your insurance kicks in. As a general rule, the higher your deductible, the lower your insurance premiums. Now, let's take a second to talk about this. Many lenders are now requiring a minimum deductible. So, for example, when you go to buy a new car, or you buy a used car perhaps, and you go to your lender, they may very well require that you have a deductible of no more than $500 perhaps. Maybe it's $1,000. You need to be aware of that. The other thing you need to be aware of when you're shopping for insurance is take a look at the cost benefit of the different levels of deductible. In my personal experience, I have seen where getting a $500 deductible gives you about the same coverage as a $1,000 deductible, but you have less risk with the $500 deductible. So once you've got your insurance, let's talk about some of the items that you might be asked about. And the first one is called a declarations page. This is essentially the summary of your coverage. A lot of times when you're buying a new car, the finance manager is going to say, listen, I need you to send me a copy of your declarations page. That's going to show that you in fact have coverage, the type of coverage you have, and the limit and cost. It's going to talk about the deductibles and what is covered. Very important page. Now, another term they use when looking at insurance is something called full coverage. It really doesn't exist. It mentions in this article that it doesn't. However, it can imply that a policy includes more than liability coverage. For example, a policy with comprehensive and collision coverage, uninsured and underinsured motorist coverage, roadside assistance, rental car reimbursement, and the like could be considered full coverage. Now, personal experience. When you go and add a new vehicle or replace a vehicle on your policy, make sure that you take a look at all of the coverages that have been added. We use a particular insurance company, and my experience has been whenever you add a new vehicle, it's not unusual for them to try to add additional coverages. For example, let's say that you're fortunate enough to have a 3-car family. Well, it might not make sense for you to have rental coverage because the truth of the matter is if you have one car in the shop, you have another one that you can use in its place. Same thing with roadside assistance. A lot of new vehicles come with roadside assistance standard. So it might not make a lot of sense for you to have that roadside coverage. Now, here's a big one to talk about, and that's gap coverage. Gap coverage works like this. You may have heard that a car's value begins depreciating as soon as you drive it out of the dealership. So for example, your $80,000 car has a value $70,000 after, let's say, 3 months. So you drive it off the lot, drive for 3 months, and you just lost $10,000 in value. You've been paying $1,000 per month. So you now owe $77,000 on a car that's only worth $70,000. Now, don't get distracted by this discussion. The difference here, this $7,000 difference, is basically what is going to be your responsibility in a traditional accident scenario. So if somebody comes by and sideswipes you, let's say they total the vehicle, hopefully you're okay during that. The insurance company is only going to pay the fair market value of the vehicle. So that leaves you on the hook for $7,000. What gap insurance does, it basically will make the difference in that payment between the amount that you owe and the amount that the vehicle is worth. Now, this is one of those things you want to look at when you're financing a car, if you're not putting a lot of money down, or if you've got maybe some rollover debt from the previous vehicle. Now, liability insurance. This is the minimum amount of insurance you need to carry. It pays for damages and injuries to other parties in the event of an accident, but does not pay for injury or damage to your vehicle. So there's the big difference. Liability insurance, covers bodily injury, the things that would, medical pain and suffering and all that sort of thing. It has nothing to do with the actual property. The property damage liability pays for damage done to property. So that will generally fall into the same thing. Now, let's talk about one more term here, and that's no-fault insurance. Now, no-fault insurance keeps blame out of the insurance game. Each party's insurance will pay injury benefits to the policy owner regardless of who was at fault in the accident. So even if you are injured by a drunk driver, your insurance pays out the benefit. It does not cover property. No fault was devised as a way to cut back on motorists suing each other for minor injuries. Now, each state determines the limits of coverage, and you're responsible for paying the difference unless injuries pass a threshold of severity. In that case, it is possible to collect from the at-fault party. But each state's going to set these things accordingly. Now, last thing we're going to talk about, personal injury protection. You may have heard this called PIP. This is the basic coverage required in no-fault states. Your state will determine specific details, but in general, PIP will cover medical expenses, lost wages, funeral costs, and essential services you may not be able to perform due to injuries. So I think we've done a good job of talking about these main topics. Look at your policy. Look at that declarations page. Look at the different pieces of your coverage and make sure that you've got the coverage that you're expecting to have. And if you've got, not much equity, you may consider adding a gap policy. So I hope this was helpful to you.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.